Did you notice on social media that a few of your friends bought a brand new truck at the end of the year? Well, did you know that they probably got that truck for 30% off? In this video, I'm going to show you exactly how they did it and show you 4 additional ways to reduce your taxable income, and so you can pay way less than what you're currently paying as a W-2 employee. But before we get into all of that, please like the video, subscribe, and hit the bell icon because I'm going to release a video every Monday and Wednesday on the Hoan Zone showing you how to multiply the assets that you own. They say there are 2 certainties in life, death and taxes. So we do our best to avoid death by exercising and eating right. And we avoid our taxes with the strategies that I'm about to show you. Last year, I've been able to write off 6 figures, which means I got to put an additional $30,000 back into my pocket. As a disclaimer, though, I must tell you that I am not a CPA, I am not an attorney, I am not an accountant, I am not any of those things. I'm just a guy on YouTube trying to give you some advice. But I do want you to take this information and I want you to share it with your tax professional and have a conversation with them and see which one of these strategies actually applies to you. Also, a lot of what I'm going to be talking about requires you to have a business. So if you're interested in learning how to create a business, check out my video on side businesses in the description below. So with that, let's start the video. So the very first write-off strategy that I want to talk about is writing off your vehicle. So the car that you drive, can that be a write-off? Absolutely, if you use it for business. So there are 2 main ways to write off your vehicle. There's the mileage way and the actual way. With the mileage way, you calculate how many miles you drove for business, and then you take the write-off for the miles that you drove. Every year it's different. For 2020, it was 57.5 cents per mile. So multiply, do the math, it's really easy. Last year I drove around 12,000 miles, 57.5 cents. Roughly $7,000 write-off is what I got. So a $7,000 write-off equates to about $2,100 back into my pocket. Now, the other way is the actual, and that's what we talked about earlier. So the actual is where you write off your vehicle based on its use. So if you have a vehicle where you're saying you're going to use 100% of it for business, then you get to write 100% off if it weighs over 6,000 pounds gross vehicle weight, right? So there's a GVWR, gross vehicle weight rating. If your vehicle is over 6,000 pounds, you get to write off the whole entire thing in the first year. So even if you bought a truck for $100,000, you get to write off that whole entire thing. So the nice thing about that is you can choose to either finance or pay in full. So that means you don't have to have the full $100,000 to buy that car. You only have to purchase it. And if you choose to use financing, so be it. So you can put $100 down and write off a $100,000 truck. So let's do a little bit of math. Say you made $100,000 in income. If you made $100,000, you'd probably have to pay, let's say, $30,000 in taxes. But if you had $100,000 come in and then you wrote off a $100,000 truck, all of a sudden on paper it looks like you made 0, right? $100,000 comes in, $100,000 goes out. Looks like you made 0, which means you got to save that $30,000 that you had to pay Uncle Sam for your tax write or for your taxes. Now, $100,000 came in, you spent $100, you got that $100,000 write-off, and you still didn't have to pay the $30,000 that you would have owned. So that's one way to delay your taxes. Now, I'm going to say this. Don't do that just as a way to delay your taxes. Buy the truck if you need it. I did not buy a brand new truck for 2020 because I didn't need one. Don't allow the tax tail to wag the financial dog. You don't want to do or make purchases based on tax savings. That's not the way you do it. You have a legitimate cost or expense that you need, buy the thing, and then take the expense, and that's fantastic. That's a win for both sides, right? So if you guys want to buy a truck because you need it for your business, then do so. Now, a little caveat, the truck, $100,000, but let's say that was your only vehicle and you used it 30% of the time for personal use, 70% for business use. Well, then you're going to have to take that percentage of write-off based on the business. So if 70% business, then it's a $70,000 write-off, not a $100,000 write-off. You guys get it? So whatever you're using for business, you got to take that off. Now, you get to add into that cost, though, all the money that you spend for gas, all the money you spend for tire rotations, for oil changes, anything that involves the vehicle. Keep your receipts, take a picture of them, whatever, but keep the receipts. That applies to the cost of the vehicle. Hoan, what if my vehicle isn't 6,000 pounds? Well, it's okay. You get to still write it off. If your vehicle is not 6,000 pounds, it's a different way. It's a different write-off. You get to write off $18,100 in the first year, and then you depreciate it over a few years. I think it's 5 total. You get to write it off over time. So if you made $100,000, you bought a vehicle that's less than 6,000 pounds, then you get to write off that 18,100. So your income now, all of a sudden, it's what is it? $78,000? No, that's not right. 82. Roughly $82,000, right? You take the $100,000 minus the $18,000. Your income is now $82,000, which is less than the 100. So you got to write off that $18,000. But again, remember, it has to be for business use. So if it's 70% business, 30% personal, then you still can only take 70% of the $18,000. So just be mindful of the business use, but track all your receipts because those are write-offs as well. And there you go. That's how you got your $100,000 vehicle for 30% off, because it saved you from having to pay the $30,000 towards your taxes and to Uncle Sam. Now, another great write-off that you can take, your house, the house that you're in, if you have a home office. How do we do this? So with a home office, there's 2 main ways that you're gonna write off that home office. Way number 1, the simplified version. If your home office is 300 square feet or less, take the simplified. How do you do that? Take your square footage times by $5, and there you go. That's your write-off. So if your home office is 100 square feet, 100 times 5, $500. If your home office is 300 square feet, 300 times $5, $1,500. Voila, right? So that's your write-off with your home office. What's great is you're going to pay for it anyway. You are going to pay for your house anyway. Now, all of a sudden, you get to write off $1,500 if your home office is 300 square feet. So there's a write-off that it's like magic, right? You're already paying for your home. Now you get to write off a portion of it. Now let's talk about the actual version. It is a little bit more complicated, but it's not bad. It's not bad at all. So let's go back to that 300 square foot office. And let's say that 300 square foot office is 15% of your house. If your house is 2,000 square feet, 300 divided by 2,000, that's 15%. So your home office is 15% of your house. So now what we're gonna do is we're gonna apply that 15% towards your expenses that you paid for in your house. That's like utilities, insurance, mortgage interest. So let's say all of that stuff was $7,000. These are costs towards your house overall. So let's say $7,000. Take the 15%, multiply by that $7,000, and then what you're gonna get is $1,050, right? So that's $1,050 towards indirect costs for your office. And then let's say you spend $1,000 for direct costs to your office. So together, you got a write-off for $2,050, right there. You're going to pay for all those expenses anyway. Again, you're going to pay for your interest. You're going to pay for your insurance. You're going to pay for your utilities. Now you get to write off a portion of it based on the size of your office. If your home office is over 300 square feet, you're probably going to want to do the actual, but just do the math and see if it makes more sense to go actual or simplify if your home office is under 300 square feet. Okay, so let's have a little fun with this. How about vacations? Can you write off your vacations? Absolutely, if they are business expenses, business trips. How do we make a vacation a business trip? Well, let's make it about business. If you want to go to Honolulu, Hawaii, right? Let's say you love going to Hawaii and you buy a rental property out there. It's an Airbnb. All of a sudden, when you go visit Hawaii, it's a business trip because you're going to check on your rental property. You got to check on it every once in a while, right? And so when you go to check on it, all of a sudden, now it's for business, now it's a write-off. So that means your airfare, your hotels, your food, your travel, like with the car, the rental car, right? All of that's a write-off. If you went to Hawaii as just a regular vacation, you're paying for all of that with after-tax dollars. Now, because it's a write-off, it's all before you pay taxes on it. That means you got 30% more purchasing power, right? So now Now the vacation is now a business trip. Awesome, right? Now, you may not have a property in Hawaii. You're like, Hoan, Hawaii's so expensive. I can't buy in Hawaii. I don't have a rental property in Hawaii. So what can you do? Learn about buying rental properties in Hawaii. Maybe go to a seminar. See what seminars are being hosted in Hawaii during the time that you want to go. And then make sure you attend. If there's an attendance sheet, make sure you sign it. Get a copy of it. Talk to the host. Email with them back and forth. So let's say your seminar was 3 days. Book a 5-day vacation, right? Book a 6-day vacation. Say you needed a day to rest before and afterwards and to network and all that kind of stuff. So the bulk of your trip is for the seminar, and then a couple of days to relax and then travel back. That makes perfect sense to me. Again, check with your tax professional. That is something that you want to make sure that there's a line, and you want to make sure that you're well within that line. If you went for a month and your seminar was 3 days, that trip is not a business trip. So you're gonna have to do some math with that one. But again, if you like going to Hawaii, try to go to a seminar, and then everything else is now a write-off. So all of a sudden, again, your vacations become write-offs. Now, again, most of these strategies requires you to have a business. If you don't have a business yet, check out my video on building business. But if you're not at that point where you have your business yet, you can still have some tax write-offs. And how do we do that? We're going to use retirement accounts. So a lot of you guys have a 401k at your job, and you guys already know this. If you put money away towards your 401k, all of a sudden it's a write-off. But are you aware of something called a self-directed retirement account? A self-directed retirement account is tax beneficial, meaning you get to put money away and it's tax deferred. So just like your 401k, if you had a self-directed IRA, let's say, and you put money away into your self-directed IRA, all of that money is tax deferred. But what's great about the self-directed part is that you can use that money to invest in real estate, to start businesses, to lend to people and generate interest. So that's a way that you can have your tax deferred strategy where it's a write-off, right? It's tax deferred. You put your money in there, you have your full amount, and now you can go invest with that. Again, you can buy properties with it. You can lend the money, collect the interest, all that. All of your contributions into it are tax deferred, and all of your gains are tax deferred. Now, when you go to retire, say age 65, 59 and a half, whatever, when you're retired, then now you're gonna have to pay the taxes. So you're just deferring it till later, but that is a way to reduce your taxes today while you still have a W-2. Now, I've been going on about taxes on and on and on. I'd love to hear from you. Comment below, what tax strategies are you currently using that you like? What am I missing? And tell us about, what are you spending all that extra money on? My final strategy is my favorite strategy, and that is being a real estate professional, or having real estate professional status. What does that mean? That most of your time is spent as a real estate investor or something in the industry, and you spend 750 hours in there or more, right? 750 hours a year. Real estate's your primary income stream. Voila, you are a real estate professional. Why it's my favorite is because it allows me to take passive losses against my active income. This one's a little complicated, so let me explain. So when you make money at your job, or when you're a commissioned salesperson or anything like that, that's active income, right? So your active income can be offset with your active losses. So your active income comes in, you make a bunch of sales, you got all this commission coming in, whatever. Your active expenses, maybe that's your travel, that's your home office, all that kind of stuff, right? So you can write those off. That makes sense. But when I own a rental property, it kicks off passive losses, right? And the passive loss that I'm talking about is depreciation. Depreciation is one of these gifts, I want to call it, gifts from the IRS, where they say that you can write off your property based on its depreciation schedule. They're saying that your property is depreciating and that you should be getting credit for that. So they're giving me a loss on paper because my property is depreciating. They're saying that there's going to be expenses that are going to be incurred by this property because you own it, and that's the depreciation, so we'll give you that credit. And what I can do is I can speed up the losses through cost segregation and bonus depreciation. So I can take massive losses, and these are passive losses, remember, right? I can take these massive passive losses and I can apply them to my active income because I'm a real estate professional. So that real estate professional status is key. This one you definitely should talk to your tax professional about. Don't just listen to me. Have the conversation. Use these videos as a platform to start the dialogue. Okay, so I'm going to take my passive losses. I'm going to apply them against my active income, and if there's enough passive losses, I wash out all of my active income. Again, my income now looks like zero or negative, yet I can still borrow money from a bank, because what bankers do is they bake the depreciation back in. So let's say I had $100,000 of income, and then I had, say, $90,000 in passive losses. On paper, it looks like I only made $10,000. But any lender will know that the depreciation's not a real expense. They will take that and they will bake it back in. And when they bake it back in, my full $100,000 is on the paper. So I now qualify for their loans. With all of the other ways that I talked about, the banker is looking at it like, well, these are actual expenses. This is going to come out of your pocket. And when it comes out of your pocket, you won't be able to pay me back. So I'm not going to lend you the money if your income shows zero. With my real estate professional status, take my depreciation, bake it back in, my income's whole, I am ready to go. I get my money, buy more assets that depreciate, I accelerate those depreciation schedules, I got more write-offs, I still make zero, pay no taxes, keep doing it over and over and over. It's a crazy game. But if you learn the rules, you get to avoid your taxes. And this is how the rich get richer, because they don't have to pay as much in taxes. But you don't have to be rich to apply these strategies. You just have to learn how to become an investor. So you've just learned 5 new ways to reduce your taxes. So what I want you to do is I want you to have a conversation with your tax professional. Get comfortable with talking about this so that you can start planning out your year and reducing the amount of money you pay to taxes so you can put more money back into your pocket. And if you're interested in getting to that next level and learning more about this, check out one of my courses or schedule a call. Go to hoanzone.com to find out more. Thanks for being in the Hoan Zone. If you like this video, hit that like button and subscribe so that you can get more videos on how to multiply the assets that you own.